Let me be completely straight with you right now. If you have more than $10,000 sitting in a bank account in America today, you are making a mistake. Not a small mistake, not a technicality, a real, measurable, financially damaging mistake that is quietly costing you money every single month, while the people who run your bank are counting on you never figuring it out. I have spent 43 years in global macro investing. I have managed billions of dollars across currency crises, debt collapses, banking failures, and market panics on 6 continents. And I am telling you with complete conviction that the situation facing ordinary American depositors right now, in 2026, is one of the most important financial moments of the last 2 decades. And almost nobody is talking about it honestly. I want you to think about something for a second. When was the last time your bank called you to tell you that you were earning too little on your savings? When was the last time a bank manager sat down with you and said, "Listen, we have a better option for your money that would actually serve your interests"? It has never happened. It will never happen, because the entire business model of a commercial bank depends on one fundamental dynamic. You leave your money there. They use your money to make money for themselves, and they pay you as little as possible for the privilege of using it. That gap between what they earn on your deposits and what they pay you is called the net interest margin. And right now, that gap is at one of its widest points in modern history. The Federal Reserve raised interest rates aggressively starting in 2022. Banks immediately started charging more for loans, but the rate they paid depositors on savings accounts barely moved. The average savings account in America today pays somewhere around 0.4 to 0.5% interest. Meanwhile, the bank is lending your money out at 7, 8, 9, sometimes 12%. You are funding their profits with your passivity. But that is actually the smaller part of what I want to talk to you about today, because what is coming between now and July 2026 goes far beyond the simple injustice of being underpaid on your savings. What is building in the American financial system right now is a convergence of pressures that I have not seen in this particular combination in my entire career. And if you have $10,000 or more in a bank account, you need to understand what those pressures are, why they matter specifically to you, and exactly what you should do about them before the window closes. Let me take you back to March of 2023 for a moment. Silicon Valley Bank. You probably remember the headlines. Bank collapses in 48 hours. Largest bank failure since 2008. Depositors in a panic. The Federal Reserve and Treasury Department scrambling over a weekend to prevent contagion. Most people watched that story and thought, well, that was a tech sector problem. That was a specific bank that made specific mistakes with a specific depositor base. It doesn't affect me. That conclusion was wrong then, and it is more wrong now. Because what killed Silicon Valley Bank was not a tech sector problem. It was an interest rate problem. And the interest rate problem has not gone away. It has actually gotten worse. Here is what happened. During the pandemic era, when the Federal Reserve was holding interest rates near zero, banks all across America took in enormous amounts of deposits. People were saving more. Government stimulus was flowing. Deposits flooded into the banking system. Banks needed to put that money to work. So they did what banks do. They bought what they considered safe assets, primarily United States Treasury bonds and government-backed mortgage securities. These were considered the safest investments in the world. But here is the mathematical reality of bonds that most people have never been taught. When interest rates go up, the market value of existing bonds goes down. If you bought a 10-year Treasury bond in 2020 paying 2% interest, And today, new 10-year Treasury bonds pay 4.5%. Nobody will pay you full price for your old low-yield bond. They will only buy it at a discount. The difference between what you paid and what it is worth today is called an unrealized loss. And the American banking system is sitting on an extraordinary amount of those unrealized losses right now. The Federal Deposit Insurance Corporation, which is the government agency that monitors bank health, publishes data on this every quarter. The numbers are staggering. At various points over the last 2 years, the unrealized losses on securities held by American banks have exceeded $500 billion. $500 billion of paper losses sitting on bank balance sheets across this country. As long as banks don't have to sell those bonds, those losses stay on paper. They don't trigger a crisis. But the moment a bank needs to raise cash quickly because depositors are withdrawing money, or because a large loan goes bad, or because confidence erodes and people start moving money out, the bank is forced to sell those underwater bonds and realize those losses. That is exactly the chain of events that destroyed Silicon Valley Bank in 72 hours. And the conditions that made that possible have not been resolved. They have been papered over and pushed forward. Now here is what has changed between March 2023 and where we sit today. And this is where I need you to pay very close attention, because this is the part that directly affects your $10,000. The commercial real estate market in the United States is in serious distress. I am not using that word loosely. Office buildings in major American cities are sitting at vacancy rates that in some cases exceed 30 and 40%. The shift to remote and hybrid work that began during the pandemic did not reverse the way many people predicted it would. Companies discovered they needed less office space. Leases expired and were not renewed at the same square footage. Buildings that were worth hundreds of millions of dollars on the basis of full occupancy and strong rental income are now worth dramatically less. The owners of those buildings took out loans to buy them and build them. Those loans are held primarily by regional and community banks, the mid-sized institutions that most ordinary Americans actually bank with. And those loans are coming due. This is not a future risk. This is a present reality. Approximately $1.5 trillion of commercial real estate loans are scheduled to mature and require refinancing between 2024 and 2026. A building owner who took out a loan in 2019 at 3% interest now needs to refinance at 6 or 7%. But the building is generating less rental income because it is less occupied. The math does not work. The owner either defaults, sells at a steep loss, or in some cases hands the keys back to the bank. When banks take losses on commercial real estate loans, it depletes their capital. When their capital erodes, they have less capacity to absorb other shocks. And when multiple banks in a region face these losses simultaneously, the stress becomes systemic rather than isolated. The banks most exposed to this problem are not the names you see on skyscrapers. JP Morgan Chase, Bank of America, Citigroup, Wells Fargo. These large banks have significant commercial real estate exposure, but they also have enormous capital cushions, diverse revenue streams, and an implicit government backstop because they are considered too systemically important to be allowed to fail. The banks I am concerned about are the ones with names you might not recognize outside your own city or state. The regional banks, the community banks, the savings institutions that have been around since your grandparents were young and that your neighbors and local businesses rely on for their deposits and loans. These institutions have concentrated exposure to local commercial real estate markets, smaller capital buffers, and far less political protection if things go wrong. And this brings me to the specific number I want to discuss with you. $10,000. Why is that the threshold? Because $10,000 is not a trivial amount for most Americans. According to Federal Reserve survey data, a significant portion of American households cannot cover a $400 emergency without borrowing. $10,000 in a bank account represents real savings, real financial security, real wealth that took real time and real work to accumulate. And right now, that money is sitting in an environment where it faces three distinct problems simultaneously, and most people are aware of none of them. The first problem is purchasing power erosion. Even though inflation has come down from its peak of over 9% in 2022, prices in America are not going back to where they were. When economists say inflation is cooling, they mean prices are rising more slowly. They do not mean prices are declining. The cumulative inflation since 2020 has reduced the purchasing power of the dollar by roughly 20 to 25%, depending on the category of goods and services you consume. Your $10,000 today buys what roughly $500 to $8,000 bought you 5 years ago. If that money is sitting in a savings account earning 0.4% while real world inflation continues, running at even 2 to 3% annually, you are losing purchasing power every single year. You are getting poorer in real terms while believing you are saving responsibly. The bank is not going to tell you this. They have no incentive to. The second problem is opportunity cost. This is the gap between what your money is currently earning and what it could be earning in equally safe or safer alternatives. Right now, with interest rates where they are, there are options available to ordinary Americans that provide significantly better returns than a standard bank savings account with no additional risk. 3-month Treasury bills issued directly by the United States government are yielding in the range of 4 to 5%. Yield savings accounts at online banks with no physical branches and lower overhead costs are offering 2 to 4%. Series I savings bonds from the Treasury Department offer inflation-protected returns. Money market funds investing in government securities are available through brokerage accounts at very competitive rates. None of these are exotic. None of them require a financial advisor or sophisticated knowledge to access. All of them pay dramatically more than the national average bank savings account. The only reason your money is not in one of them right now is that your bank did not tell you they exist, and you have not yet taken the hour it requires to make the switch. The third problem is concentration risk. This is the one that most concerns me given the banking environment I have just described. If your money is concentrated at a single institution, particularly a regional or community bank with significant commercial real estate exposure, you are taking on risk that you are almost certainly not being compensated for. The FDIC insures deposits up to $250,000 per depositor per institution. For most people reading this, the insurance coverage limit is not the primary concern. The primary concern is access. Even in a situation where FDIC insurance ultimately protects your money, there can be a period of disruption when a bank fails. Accounts can be frozen temporarily. Access to funds can be delayed. For someone living on a fixed income, for someone who needs access to their savings on a regular basis, even a short disruption can create serious problems. The answer is not to panic. The answer is to be thoughtful about where your money lies before a problem occurs, rather than trying to react after. So let me now get completely specific about what you should actually do. And I want to do this in plain language because the financial industry has a deep and profitable interest in making everything seem more complicated than it is. Complexity benefits advisors and institutions. Clarity benefits you. If you have between $10,000 and $50,000 in savings, your primary action right now should be evaluating whether you are in the best possible savings vehicle for your needs. Go to the treasurydirect.gov website, which is the United States government's direct portal for purchasing Treasury securities. Open an account, which takes about 10 minutes. You can purchase Treasury bills in amounts as small as $100. These instruments are backed by the full faith and credit of the United States government, which in practical terms means they are the safest dollar-denominated asset that exists. They are yielding dramatically more than your savings account. And they are completely outside the banking system, meaning that whatever stress develops in commercial banks has no direct impact on them. The money you put into Treasury bills is essentially lent directly to the government, and when the bill matures, typically in 4, 8, 13, 17, or 26 weeks, you get your principal back plus interest. It is simple. It is safe. And right now, it is substantially more profitable than a savings account. If you have between $50,000 and $250,000 in savings at a single bank, everything I just said applies. And you should also be actively evaluating the health of your specific institution. This sounds complicated, but it is not. The Federal Financial Institutions Examination Council maintains publicly available data on bank health metrics. There are also third-party rating services like Bauer Financial that assign star ratings to banks based on their financial condition. A few hours of research can tell you a great deal about whether your bank is well capitalized or whether it is carrying the kind of commercial real estate exposure and unrealized securities losses that should concern you. If you find that your bank is in the lower tiers of financial strength ratings, moving your money to a higher rated institution or into direct Treasury holdings is a prudent and completely rational response. If you have more than $250,000 at a single institution, the structural answer is to spread those deposits across multiple FDI-insured institutions so that no single institution holds more than your insured limit. As I mentioned in broader discussions of this topic, joint accounts with a spouse, individual retirement accounts, and individual accounts at the same bank can each have separate FDIC coverage, but the rules are specific and the structures need to be deliberate. This is one area where paying a fee-only financial advisor for a single consultation is genuinely worth the cost. Not to manage your money, just to ensure your deposits are structured in a way that maximizes your government insurance protection. Now I want to address the question that I know is forming in the back of your mind. You are wondering whether I am overstating this. You are wondering whether the people who run these banks and the people who regulate them have the situation under control. You are wondering whether the Federal Reserve would simply step in and prevent any serious disruption to ordinary depositors. These are fair questions, and they deserve honest answers. The Federal Reserve has enormous power to intervene in financial crises. It demonstrated that power in 2008, and it demonstrated again in March 2023 when it created an emergency lending facility to help banks access cash without selling their underwater bond portfolios at losses. But the Fed's ability to intervene has limits, and those limits are becoming more relevant. The Fed's balance sheet, which expanded dramatically during multiple rounds of quantitative easing, creates its own complications. The political environment around bank bailouts has become extraordinarily charged. After 2008, the public's tolerance for what is perceived as rescuing wealthy institutions at taxpayer expense is essentially zero. This political constraint means that the Fed and Treasury will be more cautious about the scale and speed of any intervention, which means the window between when a problem becomes visible and when it is definitively resolved could be longer and more disruptive than it was in 2008. I am also not naive about the fact that I am asking you to take seriously a risk that official voices are not highlighting. The Federal Reserve, the Treasury Department, the FDIC, the major banking industry trade associations, they are all in the business of maintaining confidence. Confidence is genuinely important in banking. A bank that is fundamentally sound can be destroyed by a loss of confidence, even when there is no underlying insolvency. So officials have a legitimate reason to be measured in how they discuss banking risks publicly. I understand that. But I have also watched official reassurances fail to match reality at critical moments. I watched Bernanke tell Congress that the subprime mortgage problem was contained. I watched Lehman collapse 4 months later. I am not saying we are headed for a Lehman moment. I am saying that official reassurances are not a substitute for your own informed judgment about your own financial position. The reason I keep coming back to July 2026 as the critical deadline is that several of the pressures I have described are converging on a specific time frame. The commercial real estate loan maturity wall is most acute in the first half of 2026. Congressional debates around the debt ceiling and government funding are likely to create Treasury market volatility in the same window. The Federal Reserve's policy path, whether it cuts rates further or holds them elevated, will become clearer and more consequential by mid-year. These are not isolated events. They are interconnected. When multiple stress points align in the same period, the probability of a disruptive outcome rises nonlinearly. It is not simply the sum of individual risks. It is the interaction of those risks in a system that is already carrying significant embedded vulnerabilities. I want to tell you something that I tell everyone who asks me about investing and financial management at any level. The most important decisions you will ever make with your money are not about finding the best investment or timing the market perfectly or discovering some strategy that the wealthy use that ordinary people don't know about. The most important decisions are about avoiding catastrophic loss. Losing 50% of your savings requires 100% gain just to get back to where you started. Protecting what you have built is not the boring conservative option. It is the sophisticated option. It is what separates the people who arrive at retirement with financial security from the people who arrive with regret. You have worked for this money. Whether it is $10,000 or $10 million, the number is not what matters. What matters is that it represents your labor, your discipline, your choices, your sacrifices. It represents the vacations you did not take and the things you did not buy so that you could have a cushion. It deserves better than sitting in an account paying you almost nothing and in a banking environment that is carrying risks that have not been adequately disclosed to you. Before July 2026, do 3 things. Know exactly what you have and where it is. Understand whether it is earning anything close to what it should be earning given the current interest rate environment. And take the specific steps necessary to ensure that your deposits are either within FDIC insurance limits, spread appropriately across multiple strong institutions, or moved partially into direct government securities that sit entirely outside the commercial banking system's risk profile. I have given you the analysis. I have given you the specific actions. I have given you the deadline. Everything else is up to you. And I say that with respect, not with detachment, because the one thing I have learned in 4 decades of managing money is that information without action is just anxiety. It does not protect you. It does not benefit you. It just sits there and worries you. So take what I have shared today, talk to someone you trust, spend the time this week to look at your own accounts with fresh eyes, and make the decisions that need to be made. Because the banks are not going to make them for you. Washington is not going to make them for you. The only person who can protect your financial future is looking back at you in the mirror every morning. And right now, that person has everything they need to do exactly that.